We're very happy to have this next roundtable on a topic that is very much related to the topics we've been concerning ourselves with in this Money View Symposium about the role of the dollar. And there's an adjacent related literature that deals with hierarchy of money concepts that is coming out of the post-Keynesian tradition. And we have two very prominent scholars with us today that are dear friends and fellow travelers who love to engage with these concepts. Particularly today, we're talking about a maybe forthcoming book that is sort of under this largely sort of the larger frame as you see on the screen right now, International Monetary and Financial Subordination, a Minskian Perspective. And with that, I also would like to introduce the two speakers today who are giving the input, and we're then engaging in conversation about this later. First, we have Professor Annina Kaltenbrunner. Now, kind of reminder to keep your mics muted. But Professor Annina Kaltenbrunner is a professor of global economics at Leeds University. She holds a PhD from SOAS, and she's a very active member in the post-Keynesian scene in the post-Keynesian Economic Society and other societies, very prominent. She has many PhD students that she's mentoring right now, some of which she will be presenting here at the symposium, and that we were regularly engaging in YSI as well. So we're very happy to have you, Nina, in this capacity to speak here today. And then, of course, Pablo Bortz, an old friend, YSI alum himself, who is now a professor for a number of years now at the National University of San Martin. He's been working on these topics for many years himself, so I think this is a very fruitful engagement. And just as an aside, Pablo was the one who alerted us to bring Hyun Sung Shing to the YSI Latin America convening in 2000 and let me guess 18. Yes, 18, yes. And now we almost had him for the symposium too. He's agreed, but something got in the way. So we only got Claudio Borio yesterday, but that was fantastic anyway. Thanks so much for organizing that. So we're all in the same frame here. Pablo, without any further ado, I'll hand it over to you to introduce the session and lead it off. Thank you very much.
Yeah. Well, first, thanks for the invitation and good day to everybody. I will be conducting mainly the presentation, but Nina is also in the audience, and whenever questions comes up, either of us can reply. The title is already there, International Monetary and Financial Subordination, a Minskian Perspective. Here is a broad outline of this talk, talking about traditional and new forms of IMFS, which is a shorter hand to mention the concept. We go through different layers of this work. Why this long title and what's the motivation? Well, we are in the middle of writing a book for Cambridge University Press with the suggested title of The Whip of Global Finance, Underdevelopment and International and Monetary Financial Subordination. We received the offer proposal last year, I think, and when I talked with Nina, we both agreed that we are not in the business of rejecting proposals from Cambridge University Press, so I think that is also broadly in line with the money view. We are working on this as we speak, except the fact that I have taken a couple of weeks of holidays. But so this presentation reflects the current stage of our thinking. Comments are very welcome, and we hope to profit from them as well. Now, the international monetary and financial subordination, we look at it from the point of view of developing countries. It's a long concept. Not long concept, it has a long history as a feature. It has both cyclical and structural aspects. In the terms of cyclical aspects, we usually mention the cycles of indebtedness, growth, speculation, increasing risk perception, then followed by sudden stops, defaults, and debt restructuring. These cycles are really old, really, really old. But if we would like to mark a break after which these cycles mostly developed, we can mention the key role of London, particularly of the city of London, particularly after the Glorious Revolution and after the establishment of the Bank of England in 1694. Coming back in time to the 20th century, and particularly after the Second World War, we can distinguish two types of cycles that reflects this subordination. First, the stop and go cycles, which are mostly related to trade, and if we would extend them to the current account, in which a country would grow faster and therefore its imports would grow faster than its exports, and it would hit a structure balance of payment shortage linked to devaluation, recession, and then the cycle would go on. It could be aggravated by profit remittances from multinational companies, etc. After the demise of Bretton Woods, there is this cycle is mostly called boom and bust, as Gabriel Palma calls it, or which are mainly led by developments in the financial account. Again, lending, inflows, surges of inflows leading to build up of external debt, sudden stops, and default. We can see here I present a couple of graphs when we can see the cycles already in the second half of the 19th century. I took data from a book by Irving Stone, which is amazing, and that data is amazing. And you can see the cycles here in the 1870s, then 1890, particular, that's an Argentinian cycle, lending of British capital to Argentina was through the roof that year and ended in the Baring Brothers crisis of 1890, and then different cycles with different compositions. This is looking mainly at exports of capital and financial flows from Britain, right? And you can see they were mostly dedicated to finance government and railways. I will come back to the issue of railways, but it tells us like the two main outlets for British finance, for British capital, which was funding infrastructure, as in railways, both by the public and the private sector. After the myth of Bretton Woods, we also see cycles of lending. This comes from a work of a student of mine, Jordan Manubenspa, where we see episodes of surges of capital inflows and we see different waves after the myth of Bretton Woods here, and this is Latin America, but not only Latin America, the crisis in the 80s, the boom in the 90s, which then led to the East Asian crisis, Mexico crisis, Russia, Brazil, Turkey, Argentina, and then before the 2008 the global financial crisis, and right immediately after. These are the cyclical aspects of international financial coordination, in which your economy receives lots of money, you borrow, you pay, etc. Some stuff you cannot pay, and then you are into default. There is a great book by Carlos Marichal that I always recommend on the history of Latin America debt that reflects this view as well. and one usually links it to a Kindle-Berger view. There is a structural side as well. The financial subordination is the other side of productive and trade subordination. In the book, in the introduction, we mentioned Thomas Moon, a quote by him, in which he says, well, this is a typical, the usual mercantilist style, that we need to export capital in order to sell. We need to provide them with the means to provide our buyers with the means to acquire our stuff. And then by means, they don't refer only to things, they refer to money. To the money, they need to, the UK in that case, needs to provide the money for the buyers to buy from them. In that sense, the one who provides the money can influence what it buys and what it sells, right? In that sense, the productive and the trade profile are two sides of the same coin as the financial subordination. Institutions and networks are also a structural side, historically based in London, but mainly after the First and the Second World War, also based in New York and then Singapore and other places. What was the other side of these networks in the center, let's say? Well, the networks in the colonies oriented toward trade and value transfer. In Latin America, the book by Marichal is very interesting. And in Africa, there is a very interesting paper by Kaltenbrunner, Van Graven, and Silla about these networks in Senegal and in Ghana. The usual manifestation, another structural side is the typical inability of developing countries to borrow abroad in their own currencies. They need to, they are forced to, were forced to borrow in foreign currency, but not only because their own currency was not accepted. It was also because they needed that foreign currency as a requirement for investing domestically. That is the other side of this integration into the global trade network, production network. In the 19th century, if you want, and in the 20th as well, if you wanted to invest in ports, in railways, to integrate your economy into global trade, you needed foreign currency. And that foreign currency was mostly, I don't want to say only, but mostly available for projects that fit within the structure initially, within the needs of the British economy. The 21st century, we talk about something which is like, it's the same, but different. I don't know if you heard that phrase, but there have been some similar aspects, but there have been some changes. And a conceptualization of international monetary and financial coordination needs to accommodate for exchanges. Trade is still mostly invoiced in dollars. Cross-border banking claims are still mainly denominated in dollars, even though they are the parties related are not based in the US. Corporate debt is denominated in dollars in many developing countries. However, there have been new borrowers. Many African countries which were traditionally excluded from international capital markets have been able to borrow abroad. Corporations from developing countries traditionally excluded have been able to borrow abroad. Argentina issued in 2017 a 100 years bond, which is like once in a lifetime. There have been new instruments, new currencies, and new markets in international financial markets. I mentioned here the development of local currency domestic debt market the explosion in foreign exchange trading with an increasing share and participation of the currency from developing currencies, and new actors, money managers, as I mentioned, new countries, pension funds, sovereign wealth funds, a new role of developing countries lending, not merely borrowing, but also lending. In Latin America, I can mention the case of Brazil, of Mexico, of Colombia. Then also changes in the infrastructure of this of international financial system in terms of settlement systems, in terms of payment systems, etc. So there have been numerous transformations, and if the concept still wants to be relevant, it needs to accommodate both the traditional and the new aspects of financial subordination. Let me pass here. So what are the Minskian elements that we take? In a national dimension, well, there is the importance, Minsky considers the economy as an interrelationship of balance sheets, of claims, commitments, and cash flows, with a major view or focus on liabilities, but also, I believe, on the asset side. A constant financial innovation in which new instruments appear, new forms of money and debt are developed, and there is an evolution in the financial practices and changing financial structures. That means the liabilities structure, but I will mention later on assets. However, these liabilities are not equal, are not symmetric. There is a hierarchy of money, of getting it accepted. He said that anybody can borrow, can issue an IOU. The problem is getting it accepted, right? These financial innovations accommodate, but at the same time, they deal with uncertainty. Uncertainty is all over it. And therefore, they developed different behaviors to cope with its uncertainty. This interrelationship of balance sheets are based and construct upon an infrastructure, an historical and institutional infrastructure of law of settlements, law, bankruptcy, Asian norms and conventions, right? There is, and this infrastructure also also evolves with time. And major issue as well for him is the issue of liquidity. I think you can find perhaps contradictory statements in Minsky's writings, but I think it's fair to say that for him, liquidity was not merely a characteristic of the instrument, but of the institution behind the instrument. In an international economy, hold on 1 second. In the international dimension, this interrelationship of balance sheets is one between units of different countries with presence in different countries. In this sense, this view avoids the Iceland view, as Perry Merlin has, and Borio and Sheed, and this amazing BIS paper has named. It avoids the Iceland view of international finance. This interrelation is subordinated and asymmetric. Countries are not in the same position. What was the sterling pound, then it changed. Actually, what was the Portuguese currency in the Middle Ages, then to the Spanish currency, then to the Dutch. Like there is somebody at the premium at the top, but different, an evolving subordination, which implies the subordinated liquidity. Not everybody has the same role and same position, and risk premium. There is also innovation and change at the international dimension, uncertainty at the international dimension in terms of value, in terms of default risk, etc., etc. There is an institutional infrastructure at the global level. Now, somebody, perhaps probably from a Marxist background, would argue, where is class in all this analysis? And the answer is all over it. Who borrows? This interrelation of balance sheet reflects class. And I think it is important. I want to stress that point. Class is all over. So what can we contribute? What can Nina and me contribute to the understanding of international of IMFS? First, the first thing we came up with was the definition. And I like the first definition. For us, international, and here there is a clear link with the money. International monetary and financial subordination is a constraint on the creation of externally, and let me go for different parts. Constraint on the creation of externally accepted financial assets and liabilities that in turn influences the creation of domestically accepted financial assets and liabilities. Keywords, creation, keywords, so constraint, creation, and accepted, and then influencing. For me, those are the 4 keywords here. Now, I read that definition to my wife and my mom and a couple of brothers and siblings, and they couldn't understand it. It was too technical. So at this stage, we came up with a second version. We want to find the right tune to convey the message. It can be. This second version says that it is a constraint on the capacity and terms for lending and borrowing abroad, capacity for instead of creation, and terms instead of externally accepted, lending and borrowing instead of financial assets and liabilities, which influences the capacity and terms for lending and borrow domestically. That version was understood by me. What is the starting point? Well, financial assets and liabilities, or claims and debts. These are created by the financial systems. Now, currency is one of these assets and liabilities, but not only. So what we talk here is not an international currency hierarchy. We talk about an international financial hierarchy. It's not a matter of currency, it's a matter of financial system. We look at both assets, external assets and liabilities of developing countries. As I mentioned in the beginning, we are mostly looking at developing countries. Traditional theories mostly look, and in some cases only look at external debt. Some included capital flight, which is an asset. We think that there have been many transformations on the external asset side of the balance of payments of developing countries. It includes, again, new agents, new instruments. The capacity to lend abroad is very important. Not merely in your own domestic currency, but even in dollars, is a very significant development. As I mentioned again, previously, externally accepted. Those 2 words are important. It's not an individual issue. The fact that your liability is accepted, or that you can create an asset by lending, is a systemic issue. And the terms for lending and borrowing are also systemic. We talk about constraint, no determination. First, the subordination changes. You can climb up and down. Down is for the bad, up is for the good, the ladder of this financial hierarchy. It also has there is also a feedback, an influence, not a determination of external over domestic acceptability. we want to, we think it is important to talk of influence and not determination because it has, it allows for agency in developing countries. Determination does not. Determination of external events upon domestic events leaves no room for agency. And in my view, to say that no, well, it's mediated by the context is still not enough. There has to be some role for because there is a feedback, and there has to be a role for some degree of autonomy and agency, not only by the state, but also by actors in developing countries. Now, this definition excludes, needs to exclude something because otherwise the concept would be too broad and useless as a working concept. Well, it excludes three things: international monetary and financial relations, which do not imply subordination. Now, there are difficult, it's difficult to come up with examples of it. The only one I could come up with was the receipt of a prize for winning a World Cup. Other than that, really, it's very hard to football World Cup. Other than that, it's very difficult to come up with examples. Now, there is international subordination that is not financial in nature. An occupation, for instance, of a country over another, war, etc. And then there is financial subordination that is not international. It may have influence, as I mentioned before, influenced by international aspect, but it's mostly domestic. Let's say. This this definition generates questions and a research agenda, as in a paper we are also followed by several authors, including Annina, Ilya Salami, Carolina Alves, Ingrid, Van Graven, Kay Kaltenbrunner, Jeff Powell, etc. Questions: who lends and who borrows? The capacity to do either is not a given. It changes. Developing countries have been traditionally excluded from the capacity to lend. And at times they have been excluded for the capacity to borrow as well. What is lend and what is borrow is another issue. Currency, instruments, and matched by not only what is, but who does it, and that's the next question. So in this sense, we are avoiding again this Iceland view. Who, what, and how is this constraint exercised? How are these terms set? These are all questions and research agenda that comes up. How do or did agents behave or respond to the constraint? How is this interaction between the external and the domestic exercise, and how it operates, and how it can be mitigated? It means how can countries climb up this hierarchy, or may end up going down, as in the case of Argentina. What are the, I'm about to finish this presentation with these key factors that we are working on. As I say, these are the first two chapters that we already drafted, but they need a lot of work, Financial system. As I said, this is a matter of a hierarchy of international financial system, not currency. So at the top, you don't have the US dollar, you have the US Federal Reserve. And in each crisis, the Federal Reserve, in the 2008-2020, there was a crisis of US financial system, but the dollar came up stronger because of the Federal Reserve. And this is a point that Adam Tooze makes, and I think it's wonderful. Infrastructure and the institution of the international financial system that mediates and sustains this interrelationship of balance sheets, in which the unit of account is obviously a key factor. the role of safe assets, not only the dollar, but not only US safe assets, not only German safe assets, but also safe assets within developing countries. How can central banks develop safe assets for their own financial system, and how these domestic safe assets interact with international safe assets? The role of systemically important players at the domestic, for instance, one can think of corporations and banks in developing countries that can borrow abroad. Not everybody can. Not everybody can. Those who can borrow abroad are systemically important for their own domestic economy. So this is something that needs to be taken into consideration. And we talk about this feedback between the international and the domestic. Like we talk about this ether between what is international determination and national autonomy. I stop there. Thanks a lot for listening. I already see that there are numerous questions in the chat, so I leave there and I will I leave the floor open for questions. Thank you.
Well, thanks, Pablo. I'll be happy to facilitate, but before we get to questions, Nina, do you have anything to add at the moment, or do you want to do that in the once the questions have been posed?
No, I think I just want to throw in two doubts into the room, or two things in the room which I personally haven't got my head around it yet, and where I think some thoughts or discussion around would be really, really, really helpful. And I think the other thing I was going to say, I think, you know, Pablo and I are very much in the process of, in a way, co-thinking this. So nothing is ready yet or finished yet. So there's still a lot of stuff. Yeah, it's not a final version yet. We do this as the book goes along. So I think for me, there are two questions in this conceptualization or definition around international financial subordination. I think the first one is for me, and they're literally questions. The first one is for me, what's the unit of analysis? Is it the country level, or is it the economic agent? And that means then to what extent is a balance of payments or an international investment position a useful tool to analyze these relationships? And the second question for me is, what's the distinction, if there's any, between monetary analysis and financial analysis? So I got to all of this very much through an analysis of money and the functions of money, and the differential functions of money, and the differential ways currencies assume different functions of money, and particularly the distinction between a funding currency and a, if you want to, investment currency. And I think the second question I still have not quite close for me yet is to what extent that relates to then also process of financial subordination, or to what extent can we use a purely monetary analysis to also understand processes of financial subordination, not just monetary subordination, i.e. currency hierarchy. So I think these are no, these are no arguments or anything, but I think these are for me the two really thorny questions in this analysis, which I'm not sure we have quite settled yet. But I leave it there and I give it back to the room.
Thank you.
And I'd be very thankful for any thoughts on that, if anybody has any thoughts.
We'll get into this very deeply, I'm very sure. Just for a matter of reference, Pablo and Nina, just to clarify for the room, we're very immersed in the triple coincidence paper of the BIS. We discussed this heavily yesterday, which is sort of that the currency area is not necessarily bound by the national area anymore. So I'm wondering if that's the starting point of your analysis too or not, but just so we're in the same frame or not. Is that something you're accounting for or not?
Yeah, so I think that's closely related to my first question, because I think if we go from a national view, so if it's the kind of the resident versus nationality view, isn't it? And if we kind of, can we use residency-based statistics to make inference about a country's position in international hierarchy, or do we really need to look at it from a nationality perspective? Yeah, to look at these relationships and what nationality the economic actors have. So I think, yes, that's very much related, I think, to this triple coincidence, that first question.
Great. And I think Pablo mentioned this anyway, because he says we have to get away from the island view, which is also referenced in this BIS paper perspective. So great. We're on the same page because we have been diving into these questions all yesterday. So I think we're in a good position to comment. I think we'll see many questions in the chat, but hands up first. Let's go with Perry and then Sam.
Thank you very much for this fascinating foray, breaking new ground, which I really am excited about, and I appreciate, because I grew up for 30 years in the center of the system in Manhattan, and I really don't know how the periphery works, and so I appreciate help in figuring it out, and I look forward to this book. Two just points that maybe address your questions a little bit, Nina, that I learned from the BIS. Okay, one is basically since the global financial crisis, there's been a shift in who is doing the borrowing in the global South, that from being states who are then intermediating to their local to actually being national champions in the private sector themselves. Okay, so Pablo mentioned, who exactly is doing this borrowing can change, but it's changed over time in that particular way in many states. So I think that is important, and that gets to your question about balance of payments. Balance of payments is of course the settlement constraint in international at the international level. We talked a lot about that yesterday from the key currency approach stuff, and so there may be something there for you. So the second point, again, coming from the BIS. So Pablo was mentioning a lot about the boom bust and fluctuations. So I would suggest you might look at the BIS stuff on the global financial cycle, which of course is affecting the global South, affecting the periphery in a different way than it does in the center, and that might be a frame. And in particular, you have to read sort of closely. They're being careful, but there are two issues. Okay, one is that there's a sort of a dynamic of fluctuation in the global dollar system that is inherent in the instability of private credit, period. Okay, so there's that instability, which is then hitting all the countries, but maybe the global South more. Secondly, there's U.S. monetary policy. Since it's a global dollar system, U.S. monetary policy affects that cycle also, and those two things are overlaid, and they both affect the global South. They're careful never to say the cycle is caused by U.S. monetary policy or something, because I think they can't say that. Okay, but you could, for something like this, or at least consider. What are the objectives of the Fed? Since you're putting the Fed at the top, that puts U.S. monetary policy at the top. So I'll just stop there with those two things, and that might also get to your second question about monetary. How does relation between monetary subordination and financial subordination?
Great, thanks, Barry. Let's take one more question for now, and then bring it back. Sam.
First of all, thank you, Nina and Pablo, for that presentation. I learned a lot from it. One of the things that I am observing in the research that I'm doing is that there are many very fascinating analyses, just like the ones that you presented, looking across the last 200 years or 150 years. And they focus on the pre-World War II era and the post-1970 era, and they completely leave out this rather remarkable period in terms of, in particular, thinking about international financial flows and liquidity crises. I just put in the chat a graphic from Bortz work that I find just remarkable, showing this 30-year period in which there were zero banking crises in over a dozen countries. And he identifies this in many respects as being a lack of liquidity crises. And so anyhow, I wanted to know why you have, at this point anyway, decided to leave out that era. It feels to me from what I heard today, and maybe I misunderstood that, and encourage you to really include a focus on that era in your book, for my sake, as someone who's researching that era.
Great. I think we actually take one more question now, since Sam's question was pointed. Karen, you can go quickly for your third question, then we can bring it back to Nina and Pablo.
Yeah, I missed a little bit an analysis of the asset question. A lot of these flows were generated by the generated acquisition of assets. I think it would be very interesting for you to look at the Over and Gurney crisis, 1866, through which and by which token Britain, or private interests managed to take over the Argentine railroad system, and thus creating a dependency that has persisted throughout. You can look at also, I mean, I look at that in the context of, inversely, the modern crisis around 2000, which was caused by a lot of privatizations that really were funded by Argentina itself and created this enormous indebtedness, but whereas Argentina had given away its assets and creating at the same time an enormous debt. So I think that you have to look at also these questions about what are the acquisitions that foreign capital are reaching in these countries, because they also influence on these financial flows and monetary system and so on and so forth. So the problems go very deeply, I would say.
Great. Can I start answering?
Yeah, go ahead, please.
I'll start with Perry, then Samuel, then Karen, and then the questions in the chat. Perry, since 2008 shift in who borrows, yes, that's one of the transformations. I mentioned the growing share of the growing importance of corporate borrowing, but not only them, African countries borrowing abroad, that's mostly a feature of the post-global financial crisis period. So yes, I take it, we have that in mind. About the issue of the global financial cycle, the answer is yes. It predates the 21st century. I mean, that's why I show a graph of London lending. But about your questions of how this cycle interacts and determines domestic cycles, well, the best article I've read on the topic was written by the guy who's gonna ask me next, which is by Iñaki. And his work is very interesting in the sense that countries are different in the boom. The global financial cycles affect countries, developing countries, differently in the boom phase, but it affects them very similarly in the bust phase. That's the thing that I take from Iñaki's work. So that's why we talk about. And he can put the link and promote his work in the chat. But that's for my main take from his work. So and therefore, yes, there is a role for U.S. monetary policy. I mean, I mentioned like what sits at the top is not the dollar itself; it's the Fed. For instance, as you mentioned, through the network of, as you have written a lot. Writing a lot on this network of swaps, who gets included and who doesn't, the liquidity provision at times of stress. The COVID crisis was another example. Developing countries stabilized only after the Fed opened the gates to Brazil, to different to countries in Asia, when through different lines. That was when developing countries could stabilize their own currencies. And after that, they could implement their own quantitative easing and non-conventional programs. It was only after the Fed stepped in. So yes, we take great care of the Fed, of US monetary policy. About the question by Samuel, it's a very interesting one. If I were going to, we will have a chapter on policies, macroeconomic policies. So in that sense, there will be an echo of the policies implemented during the post-war period. But that period was also the development of the euro-dollar market. And that is also, we are also, personally me, but it's also important to look at the development of the euro-dollar market as a precursor of the crisis that will come to happen after the demise of the Bretton Woods era. Karen, analysis of assets question. Yes, we look mainly at financial assets. We could include privatization. There are two sides to this. First, they struggle, as I mentioned, there is this interplay of financial subordination and productive profile, and privatization might come may be significant in that second side. And then there is a look at assets, at financial assets. Brazil, for me, it's not the same. These are all external financial assets, but they are very different in nature. A deposit in Switzerland, film, a fund.
Pablo, we have a trouble coming from your audio, unfortunately. Can you try it?
Now, can you hear me? Can you
like a
hear me
robot.
now?
Maybe
Okay.
maybe just hand it to Nina for a moment. How about that? Okay, now it's better. Now we're back. Now we're back. Yeah, go ahead.
If there is some background noise, I apologize in advance. There are very different external assets of developing countries which have been growing and in size and in diversity. Pension funds of developing countries lending abroad, sovereign wealth funds of the Gulf countries, of Asia, Singapore, etc. So there is a lot of diversity, a growing diversity in external assets, external financial assets of developing countries that is very, very important to take into consideration. I think I didn't hear well the time of the crisis that you mentioned, Karen, but I think it refers to the Baring Brothers crisis in 1890. I take it. If not, please correct me. And yes, that is one of the examples that we mentioned in our first chapters. Questions in the chat. Funded instead of accepted. It's a very interesting discussion when look at it from an international angle, from a developing country perspective. I think funded it's something that we need to think about, definitely. I would argue that if you can fund it, it's easier, especially on the asset side, to get it accepted. For instance, sorry,
Okay, he's frozen for me.
Yeah.
If you get it funded, you can get it accepted. I think that was his point.
sorry, can you hear me now? I'm
Yes.
back.
We lost you when you said you can get it funded, you get it accepted. I think that was the last.
It's much easier, yeah, definitely. But I take the example of Brazil. We are both and Colombia. Brazilian banks have been lending abroad a lot in dollars. Colombian banks are expanding into Central America. So, and they do not lend in reals or Colombian pesos, they lend in dollars. But it's important for the how they fund it. However, I think we will very carefully look at this issue. I mean, Nina is one of the main experts on this, and this is her key, one of her key pivots, and she can reply instead of me, of course. But actually, for me, this was the issue that led me from the currency hierarchy to the financial system hierarchy. The issue of funding is the step that led me to to change from a currency perspective to a financial system perspective. So yes, we take that very much into consideration. And I leave it at that. I don't know, Nina, if you want to add more, or we can just open the floor for other questions from Iñaki, etc.
I have three very quick follow-ups, and again, they're mainly in terms of questions. I think the funding, I totally agree. Jay had a follow-up about this. I agree. I think the big question is about whether it's held to maturity. And I think that makes a difference, whether it's just accepted or whether it's held to maturity, I think makes a qualitative difference. And again, thinking about in terms of money terms, that's for me the difference between being, and my student Bianca Orsi has done very great work on that, the difference between a short-term investment currency and a true store of value, a store of wealth. Which the post-Keynesian make, and I think that's really a key distinction here. I have two quick follow-ups to Perry, and I'm sorry for taking that space to have these discussions, but these are things that are really on my mind, and I hope we can do it in another form a bit longer. Going back to the question of who, the nationality versus the borrowing, I agree with you. You look who borrows, but again, coming from a money view, it's actually wouldn't be our key analytical. In a way, that the agents we really want to look at are the banks, aren't they? And what are the bank or the financial institutions, if we want to do, what are the global financial institutions doing, and what monies are they denominating their assets and their liabilities in, and how that interacts with the currency hierarchy and the acceptance of currencies in the system. So that's my first big question. And I guess the second one, I wanted to react to something which you said, and which is something I've been thinking about a lot, is to what extent, and we all agree that the balance of payments is the ultimate settlement constraint. I agree with that. But for me, the question is whether the ultimate constraints, or in a way, the first constraint is the acceptability of the currency in the first place. Because you could always fund yourself in domestic currency, exchange that currency into the funding currency, and settle your liabilities. And you can go, if a bank is willing to do that, you don't need to have, there's no immediate, you don't need to have the foreign exchange there, here, there. It doesn't need to come from the balance of payments. Sooner or later, the balance of payments is going to kick in. But for me, the question is whether the prior constraint isn't actually the non-convertibility of the currencies in the foreign exchange markets in the first place. So these were a couple of very quick reactions and comments and thoughts, but just very much to say that these are open questions for myself as well, and I haven't really closed them yet for myself. Thank you, Jay.
Great. Yeah, these are definitely open questions for all of us to figure out. I'd like to hand over. Let's take 3 questions coming up now. Natalie, if you're still there. Iñaki goes first. Natalie had her hand up earlier. I'm not sure if she's still willing to ask, and then we go with Alex.
Okay. Hi, everyone. I'm waiting for the time to pass, and apologies for the background noise. As you can see, I'm having the street hi to Pablo and Nina. This was a very interesting presentation. I just didn't want to leave Nina empty-handed with the first set of questions that she asked in terms of nationality versus residence and what's the right approach there. And I'm kind of, it pains me to be boring, but I'm going to give the typical economist answer, which is, it depends, and you cannot really marry to one and just go, straight through with that option forever. And there are good cases in which the residency basis will give you more, if anything, because you cannot get anything from the other route, which is one issue that Claudio mentioned yesterday regarding a project started by colleagues at the BIS. When you try to do a sort of consolidated wealth of nations, it's something that is extremely hard. And to put an example where, in the BIS work, there's plenty of examples on where the nationality view can kick in, but to tie it up with an example that Perry gave, which is about how post-GFC borrowing in the periphery is done mostly by corporates. I think there the data is very good. And in addition to the plug that Pablo made to our paper, Pablo and Perry made to the paper on global financial cycles, we have also an article on corporate debt where we quantify this. And it's huge, in particular for emerging markets, and it's huge in the following sense. It's especially corporates from, say, China, Russia, Brazil, India, and a couple others that issue offshore through non-bank financial affiliates. That's going to be entirely missed if you take a residence perspective, but it's going to be critical to assess the riskiness of those corporates, no, on a consolidated basis, on kind of a decision-making unit basis. So that's a very clear case where you say like, okay, that merits a nationality view, but there the data is good, and we actually make it fully downloadable. So go and check it. So I just wanted to make that point. Thanks.
Yeah, Natalie, over to you.
Natalie.
Hi, Nina. Hi, Pablo. Thank you very much for your presentation. So my question is maybe a bit easier and more macro related. So thinking about Rellen Ray's paper, that she also highlights the role of the dollar or the role of the Fed as the main driver of the global financial cycle and how it spreads to other countries to justify her dilemma approach. So in your financial subordination framework, what is the role of the exchange rate regime, if any? And in what sense does it differentiate of Helen Ray's approach? So that's my question.
Okay, we'll squeeze in one last question, Pablo, if that's okay, with Alex. And then we'll hand it over to Nina and you again to close out the session.
Yeah, this is following up a little bit from a back and forth that Matthew and I are having in the chat, where we're talking about comparing the idea of subordination or the perspective of subordination with the perspective of subsidiarity that Dan Nielsen was talking about in his most recent post. The idea that the top of the hierarchy is serving as a backstop to the bottom of the hierarchy, and you only move up the hierarchy as needed. So there's this question of, is it kind of this noblesse oblige, with great power comes great responsibility, or should we be thinking about these money and credit hierarchies as more kind of bottom up structures, where, for example, you have a bunch of banks that come together to form a clearinghouse, and they've created a hierarchy for their own benefit. So cooperation leads to centralization, which implies hierarchy, that kind of thing. So I'm wondering about these questions and kind of how they apply at the international level, and to what extent you guys have thought about that.
Nina,
Great,
you want to go ahead, or I can go?
You can go.
I can go. With the work of Helen Ray, I mean, I really like it, and the role of the exchange rate regime. I take for me I think the distinction between the cyclical side and the structural side of international financial subordination is an extension of Helen Ray's work. I see her work mainly as a cyclical side, but I also see it as hiding the great heterogeneity within developing countries. Now, I agree with her main point that whether you have a floating exchange rate, a floating or a fixed exchange rate regime, it may make a difference, but not that much. Therefore, that's why she talks about a dilemma, and I support that stance. I just to say that I do agree with it. I think that the exchange rate is not a stabilizer. I think it is a floating exchange rate regime is not a stabilizing. It at times it can be it can amplify shocks, so it doesn't necessarily absorb them. In that sense, the issue of the regime is important, but secondary to the question itself. But I think that there have been institutional transformations. If we want to tackle the issue of financial subordination, I will refer later on to Alex. we need to take, we need a conceptualization that can accommodate these transformations. Otherwise, the concept is useless. And I still think there is value to it. But we need to include as well all the structural transformations that have been going on, which are not there in the work of Helen Ray, and that's fine. It's not a criticism on her, but I think that we, in that sense, we are expanding much more on that side. Subordination versus subsidiarity. I really like the word influence and constraint in our denomination, and I emphasize a lot against determination. I think one needs to leave a room for agency in developing countries. They can, they will. It's very hard to be the U.S. Fed. I mean, it took a world war for the Bank of England to stop being the Bank of England, and the Fed taking two world war, and the Fed taking its place. But we can think about the rise of China. In 50 years' time, we may be talking about the rise of India, right? Of the Indian rupee. Who knows? But I still think that the issue of agency must be in the table, whether we talk of subordination or subsidiarity. I need to dig in deeper into what Daniel has written, but I would emphasize this. The issue of agency needs to, because I still think that there are policies to move that countries cannot. Peru has gone from a totally dollarized financial system to a financial system mostly denominated in its own currency, and that was through policies. So I would argue that the concept needs to leave some room for agency. I don't know if Nina wants to. I think I answered all the questions in that sense.
I just want to come in very briefly on the exchange rate question. Natalie, I think whilst in principle, I still think that a managed exchange rate is probably the best. So some, like not a fully fixed, not a fully floating. I think the more I look at it, it's just the more you see how hard it is to do whatever you do with your exchange rate within these subordinate structures, and that probably exchange rate regimes are not sufficient to make that much of a difference, and there needs to be such more of a comprehensive policy package to really deal with it, rather than just the exchange rate regime.
I
Well,
totally agree.
I think this fits quite well. I think there's an open question that we have not resolved yet with the key currency idea that we were opening up yesterday, which is, of course, what is fully developed in the Kindleberger idea is that there needs to be cooperation amongst the core to stabilize the core currencies. But I don't think we have fully developed the conversation about what happens with those who are sort of followers to the system, even in the Kindlebergian perspective. So this is a really open question. I think maybe Perry, you have an answer to this right away. If not, we'll close the session. What do you think, Perry? Is there some answer you have for us at this moment before we close?
Well, I would just say that the international hierarchy, I have always emphasized, is also a hierarchy of hybridity. And I think that's what you're seeing, in the periphery, where the less financially developed, means the state is playing a bigger role, and financial development is part of what is happening in these countries, and part of why now the non-financial corporations, as Iñaki was emphasizing, can now tap the global capital markets, but it's also because of monetary policy in the north, because of zero interest rates, and reaching for yield by the insurance companies, which are the ultimate funders, actually, of all of this stuff. So I think that thinking of this hierarchy as a hierarchy of hybridity may be a way to make a connection. I also have been just communicating to Nina and Pablo. This money versus finance thing, I think, is about payment versus funding. And that little paper I have is I think maybe relevant there. It's a little abstract in that paper. So extending that to international maybe is not obviously straightforward. Okay, but possibly we can communicate offline about that. I think it conceptually it goes exactly into extension to internationally, but always the devil is in the details. I appreciate that.
Great. Any closing thoughts from our panelists?
No, thanks. First, thanks a lot. These are issues that are very. I think we took a lot from this discussion. There are many issues to include, to probably modify, to explain better. The discussion in the chat about the Bretton Woods phase. I think we will try to incorporate probably in the macroeconomic policies part, issue of subsidiarity, of hybridity. I like it to think about heterogeneity, right? There is a lot of heterogeneity going on there, but no, it was a great discussion, and personally, I really benefited from it. So. Thanks a lot to everybody involved.
Same here. Thank you very much for the discussion. And I'm glad to see I'm not the only one who's got open questions, and that my open questions aren't closed ones yet for everybody else. So it's good to have this forum to discuss this and find this out.
Great. We'll have you back. We'll talk about in other forms going forward. Looking forward to your book. Thank you both, Nina and Pablo.